In this lecture, we will dive deeper into how to read and understand candlestick charts for technical analysis. We will go over how to read individual candles, explain what each candlestick color represents, and explain why they have lines or wicks running through the middle. Also known as a Japanese candlestick chart, a candlestick chart is used to analyze and predict the future movement and price of an asset using past indicators. It can be used to describe the price movements of various assets including stocks, securities, derivatives, fiat currency, or cryptocurrency. On a day chart, each bar on the chart is considered one candlestick and represents one full trading day. Each candlestick shows one day, so a 1-month chart will show 20 trading days or 20 candlesticks. Each candlestick can show you the market's open, the high of the day, the low, and where it closed. To keep things simple, we will only be looking at day charts for trading cryptocurrency, but you can use candlestick charts and strategies for shorter or longer intervals as well. On a minute chart, each candle represents 1 minute. This is great for day traders and other short-term traders. On a monthly chart, each candlestick will represent 1 month and could give great insights to swing and other long-term traders. When analyzing a single candlestick, this is called a simple pattern. But to get a much clearer view of the pattern, it is best to combine multiple candlesticks to analyze potential price movements. Here we take a closer look into each of the different colored candlesticks. These are graphical representations of the price movements of a stock or cryptocurrency for a certain period of time. Using candlesticks can be very helpful for every strategy, whether it's day trading, swing trading, or even investing. They can give valuable insight into potential market turns before traditional indicators, which will improve your timing when entering and exiting your positions. Candlesticks are usually shown in one of 3 colors. The candlestick body may vary depending on the platform in the chart you're using, but you will basically have 3 different colors. The lines at the top and or bottom of each candlestick is called the wick. For this example, we will use the traditional white, red, and black candles. Each candlestick color represents different price action for the asset on a particular day. A white candle represents the price closing higher than the previous day. This is a bullish candle and means the day had more buyers than sellers. A red candle represents the price closing lower than the previous day. This is a bearish candle, which means the day had more sellers than buyers. A black candle represents the price closing below the opening price, but higher than the previous day's price. This is a neutral candle that represents indecisiveness. Let's take a closer look at how to read and analyze each single candlestick. So here's an example of the 3 different candlesticks: a black neutral candle, a red bearish candle, and a white bullish candle. This image actually represents 3 days of price movement for a particular stock that I was looking at. The top of the vertical lines, also called the wicks or the shadows, represents the highest price that the stock reached for that particular day. The bottom of the vertical lines or wicks represent the lowest price that the stock reached for that day. The top of the actual colored bars or the candle body can either represent the price in which the stock opens, which means the first price that was traded on that day, or where the price closed, which is the last price traded before the closing bell. For white candles, the top of the bar shows the stock's closing price, and the bottom of the bar shows the opening price. For red candles, the top bar shows the opening price, and the bottom of the candle shows the closing price. For black candles, the top and the bottom of the candle can either be the open or the closing price. The patterns that these candles form can provide great insights into potential price movements of a stock or cryptocurrency. So now let's go over a few examples of some simple candlestick patterns formed by individual candlesticks. Looking at a candlestick, you can identify a cryptocurrency or other assets opening and closing price, the high and low of the day, and the overall range for the specified time frame. Simple candlestick patterns describe the meanings of a single candlestick shape. There are dozens of simple candlestick patterns that you can come across. These patterns can either be described as bearish, bullish, and sometimes neutral. Bearish is when there are more sellers than buyers, and bullish means that there are more buyers than sellers. When buyers and sellers are about equal, this forms a neutral candlestick pattern. Candlestick charts serve as a cornerstone of technical analysis, so it's important to become familiar with the candlestick patterns. They are crucial for identifying trends and patterns for successful trading. So let's go over a few examples of the most common and well-known simple candlestick patterns to help you get a better understanding. The first example shows a single candlestick in a simple shooting star pattern. This occurs when a stock opens higher and continues higher during the day, but falls and closes lower near the opening price. This candle has a short body, a long upper wick, and little or no lower wick. The long upper wick shows that buyers drove the price up significantly during the trading day, but selling pressure drove the stock price back down by the close. During an uptrend, the shooting star candlestick can signal a potential stock price downturn. This is called a reversal pattern. Next, we have the hammer and the inverted hammer simple candlestick patterns. The hammer is a bullish pattern that can indicate a reversal from a stock price decline and can represent either the bottom of a trading range or a support level. The long wick at the bottom of the candle shows that sellers drove the price lower during the trading day, but the stock price recovered and closed above the open. A hammer either has no top wick or a very short top wick. The inverted hammer is similar to a shooting star, but instead of signaling the start of a downturn, the inverted hammer can signal a potential upturn in the trend. The long wick at the top of the candle shows that buyers drove the stock price up during the trading day, but it fell back down before the close. The inverted hammer either has no bottom wick or a very short wick. The hammer or inverted hammer reversal patterns can be reinforced by large stock volume. Next, let's take a look at some of the Doji simple candlestick patterns. A Doji simple candlestick pattern forms when the closing price is the same as the opening price. The length of the wicks can vary, but the body of the candle will appear as a short straight horizontal line. This represents indecisiveness in the market where supply and demand are virtually even. During an uptrend or a downtrend, a Doji candlestick shows a trend reversal may be starting. Other candlesticks and information should be used before confirming. The Dragonfly Doji is when the open, the close, and the high of the day are all the same price. This creates a long lower wick with a short horizontal line at the top, which forms a T shape. This shows that the stock fell during the day, but buyers drove the stock price back up by the market close. This is a potential reversal signal for the current stock trend, but other candlesticks should be used to confirm. The Gravestone Doji is when buyers drive the price up during the day, but sellers are still prevalent and drive the price back down to the opening price before the market closes. This forms an upside down T and signals a trend reversal. But of course, you should use other candlesticks to confirm. Although single candlestick patterns can be very helpful, they are best used when grouped together in order to see a clearer overall pattern. A group of candlesticks is called a complex candlestick pattern and is better for price prediction. The more data you have, the more accurate you tend to be.